Are you a home buyer in today's market? Are you waiting for the market to go down? I'm going to share exactly why that is the wrong strategy. Coming up on this week's version of the Silicon Valley Snapshot. This is Danny Gould with the Selling Silicon Valley Group. Welcome everyone to another Silicon Valley Market Snapshot now for the first week in August of 2020. Is it just me, or does it kind of seem like this whole year has just gone by in a flash? I'm shocked at how fast everything's moving. The market's moving incredibly fast. COVID has seemingly not slowed down the market since about mid-April. So we had about a 3-week period where everyone lost their marbles, and then all of a sudden now we're kind of back and humming along. And if you've been watching these videos, you'll know exactly why. Inventory is down significantly year over year. Now, before we get into the data, I want to remind all of you, if you are a home buyer in today's market and you're looking for a very comprehensive data set, very similar to what we share in previous market snapshots and the one that you'll see today, if you're looking for data like that, go ahead and text the word data plus the zip code that you're looking in, or the neighborhood or the area or the city or the zip codes that you're looking in, and we will get you a very comprehensive data set for your particular situation. And if you're a home seller in today's market and you're looking for the most robust comprehensive data analysis on your property, go ahead and text the word data plus your property address to the number down below, and we will get you the best data that you've ever seen. And in this market, having that data is crucial in order to make sure that you are pricing your home appropriately, because pricing, like I said before, in this market, it's just an imitation, baby. So let's get into the numbers, and we're going to switch it up this week. I generally share some iteration, some version of a trend graphics report, which is basically a data curator pulling straight from the multiple listing service. But we're not even going to get into the data. We're right at the beginning of August. It's August 5th. There's not enough data month to date to really draw any sort of statistical conclusion. Also, there's no actual statistics available for the month of July, for the whole month of July. So we're kind of in this holding pattern. But for today, what I wanted to really focus on, we all know what the narrative's been up until this point. If you've been watching these videos, you'll know that the narrative has been inventory has been suppressed ever since, well, the beginning of the year, really. We've had low inventory levels, right? And to piggyback on top of that, the demand has risen now above where we were at last year. Month to date, year over year, and year over year. If you just look at the numbers, right, it's very clear cut. It's very obvious that in most parts of the Bay Area, we're experiencing higher than normal demand when looking at last year, and far fewer homes for sale. It's causing basic economic supply and demand conundrum. Prices are going up, period. And buyers, if you're on the sidelines right now and you're waiting for the market to go down, I'm going to share with you a couple of slides here, a couple of pieces of information that should really make you second guess whether or not you're deploying the right strategy by holding off and waiting. By the way, disclaimer, because I know I'm going to get some trolls. They're saying, Danny, you're just saying this because it's your job to sell houses, and you are the worst person in the world because you're convincing people and you're manipulating them into think. Okay, I get it, right? I get it. You guys believe that I'm giving you this information because I'm a salesperson. Let me put it to you this way: I myself am in contract for a home right now. I'm not just, giving you the Kool-Aid and telling you to drink it. I too am drinking the Kool-Aid. So if you think right now that I'm just giving you this information because it's convenient for me, that is simply not the case. The reality is that right now, the interest rates are historically low. We haven't seen interest rates dip this low in over 50 years. 50 years, think about that. The last time that you could do that, a loaf of bread was like 5 cents. Think about that. I mean, it's scary. It's scary to think just how long ago or how long it's been since buyers have had this type of opportunity to lock in a low payment for 30 years, the lowest possible payment that you could have ever gotten in the last 30 years. This slide right here should paint the picture for you. This is a buyer's purchasing power based off $1 million sales price. I gave something very similar to this a few weeks ago. And if you're a home buyer, pay attention. Right now, many of our buyers are getting rates as low as 2.75% based on credit, income, et cetera, right? And I'm not saying that all of you can qualify for 2.75, but a lot of you can, my guess. At $1 million at a 2.75% interest rate, we're looking at $4,082 per month. That's your principal and interest payments, okay? Perfect. The market would have to dip 2.5% in order for you to be paying roughly the same amount at 3%. And as you go down that table, right, and really study, analyze it, pause. And by the way, if you want this slide, go ahead and text the number down below, text slide to the number down below, and you will get this slide right there in your inbox. So 950, 4134 payments, negative 5%. The market would have to dip 10% in order for you to pay practically the same amount, and not even the same amount, $100 more at 3.75% interest rate. Okay? You can't, these are facts. These are facts, meaning that not if, but when the interest rates climb back up, the market would need to dip 10%. Well, if they climb back up all the way to 3.75, say, which, by the way, less than 2 years ago was what most of my clients were paying. In fact, a lot of my clients for a 30-year fixed, I would say at the height, were paying somewhere in the low to mid fours, right? Now, of course, there's a lot of different loan products out there. You can get an adjustable rate. Like a 5-1 arm, a 7-1 arm, a 10-1 arm. The rates are going to be lower. You could have a lot of money and put it into a CD with fill in your lending entity of choice, and they will buy down the rate for you because they want to keep your money in house. So there's a lot of ways to manipulate that and get the rate down. But the point is that if you are an average home buyer, I would say, right? Well, don't take it personally, but if you're an average home buyer, right, with average savings and average income and a great credit score, this is you. This is you. And for you to sit here on the sidelines and wait for the market to come down, I don't know, guys. I don't know. It doesn't seem like the smart play. It really doesn't, because this is the known. You are locking in a rate for 30 years. You know what the rate is going to be, right? You don't know what the market's going to do. So as long as you're confident that you can make those payments and sustain them for the next 30 years, then there really should be no question in your mind whether or not you should be buying today. Now, I know there's another question right now. Well, what about, after the election, and like, what if I can get a better deal? Great, Mazel tov. Go wait until the election. Honestly, you really probably could sort of get a better deal. However, let's count how many months there are between now, August 1st, and November 5th. August, September, October, November. Okay. Last night, shout outs to my client, Tao Nguyen. Tao astutely pointed out to me, she's like, hey, I was studying these comparables. She's a really smart girl. She's like, hey, I was studying these comparables, and it looks to me like every home sells for about 5% more than the last one in this community. Okay, this is since like May, right? And or no more than 5%, but somewhere between 3 to 5%. Okay, so let's say a home goes into contract in the neighborhood that you're looking in today for 3% more, right? It closes September 1st. That becomes the new comparable. So then they go another 3% more, right? That's 6. September, October. That's another 3% more. That's 9%. Let's do some math. November comes around. People get a little skittish. There's less inventory, but there's also less buyers. By the way, don't kid yourselves into thinking that there's going to be a massive inventory surge after the election. Not going to happen. Inventory levels are going to remain suppressed until we have a vaccine. Okay? So we go all the way until November 5th, right? How many percentage points has the market appreciated between now and then, right? And this is in the area that Tal's looking in, so there's other areas where the appreciation schedules perhaps a little bit less. But there are also appreciation schedules where there's a little bit more. 9% sounds like a lot, guys. Let me put it to you in perspective. This week, we put a home on the market, or this last week, we put a home on the market for $900,000. I don't expect it to sell for anything less than $1.1 million. The market's not going to dip 20% after the election. So every time you allow a home to slip by, is you are giving your money away, right? Overpaying feels like giving your money away. That is not giving your money away. That is beating all the other buyers to the punch so that you can sit there in your home on the sidelines eating your popcorn and laughing at them while they pay more for the same house down the street than you paid for yours. That is called #winning. So now look at this next slide here. Even in a very conservative world, in the most conservative of worlds, let's say that between now and Q4, we have a 0.5%, not 9%, like I just talked about, a 0.5% difference or a 0.5% appreciation over the next 3 to 4 months, right? Guys, if you're following the market, you'll know that that is the most conservative of estimates. And let's say that the interest rates, based on average commitment per Freddie Mac, goes up 0.1%, not anything astronomical. The difference in your principal and interest payments are going to be $76. Doesn't sound like a lot. The difference in the life of the loan, though, over 30 years, if you're a finance person, this makes a lot of sense to you, $27,000. It's a lot of money, right? Focusing on the price and not the rate right now is not the right strategy. Pricing is going to remain very consistent. Home prices are going to remain on the incline until we see some sort of, I would say, adjustment in the number of homes that are available for buyers to buy. We've always had an inventory issue here in Santa Clara County, San Mateo County, Alameda County, especially in San Mateo County. My goodness. So when you talk about some of these core markets, Alameda County, when you talk about some of these core markets in Silicon Valley, what you're really hedging your bet on is whether or not there's going to be more sellers in the next 6 to 12 months, which allows you to have more options, which allows the rest of the market to have more options, which basically allows you to have less competition, right? And then ultimately feel like you're getting a deal. I'm at the point right now, everyone, where we've been doing this so long, and I've seen how the market's behaved. And you've seen these infographics that I've shared before, how even in the recessions, housing seems to go up, right? There's always going to be dips and valleys, but I am convinced now more than ever that the housing market here is so strong that it can weather even the most severe of storms. And so to sit on the sideline and wait, I just do not see that as a viable strategy if you're really looking to win in this market, because that's basically it. So I know I'm going to get some people that do not agree with this, and I welcome your judgments, and I welcome your criticisms, because I would love to hear. I'm not so close-minded as to think that I am the end-all be-all resource for Silicon Valley data and Silicon Valley numbers in the real estate space. But you listen to you talk to economists, you talk to real estate experts, or I say me. I've talked to economists. I've talked to real estate experts. I've studied the market, and it's led me to this conclusion, which is a year from now, homes are going to be more expensive than they are today. So if you're going to sit on the sidelines, you're going to be waiting a long time. And then how much, then it comes back to, well, how much rent are you paying? And then how much, and you guys already know those arguments. It's like, well, how much rent am I paying? How much money am I giving to my landlord that I'm not putting into my house? How much tax write-off am I missing out on? And this is, of course, if you're a home buyer, a first-time home buyer. Oh, and my goodness, if you're a move-up buyer right now, this is the perfect time to get in. By the way, if you're a move-up buyer in today's market, and you're looking for a strategy where you only have to move once, I have a product available, exclusive only to Selling Silicon Valley clients, where we can actually help you fund your home purchase, right? At no cost to you, help you fund your home purchase, make a non-contingent offer on the sale of your property, and then retroactively sell your property for the highest possible price. You get the best of both worlds. You get to get inside the home, right? Make a non-contingent offer, make the most competitive offer you could possibly make, and then sell your home afterwards. So if you're interested in learning more about that strategy or that solution, that product, go ahead and text the word trade in to the number down below, and we will send you some information that kind of guides you through what that looks like for you. Many of our clients are using that product right now to get them into their dream home before they sell their original home, and it is honestly, it's a game changer. So, anyways, that's all for you guys today. This is a way different video than I'm used to shooting, but honestly, I just I got on this yesterday. I started thinking more and more about why buyers are sitting on the sidelines and trying to explain as best I can, and I hope I did a good job, as to why sitting on the sidelines makes no sense, A, from a monthly payment perspective, and B, from an overall growth trajectory perspective, and how the market dipping could end up not even making a difference in the amount that you're paying on a monthly basis, which at the end of the day, isn't that what you're most concerned with? That's what I'm most concerned with, right? So anyways, that's pretty much all I got up for you guys, actually. So like I was gonna do something else, but it's okay. Video's gone long enough. But anyways, guys, again, remember, if you're a home buyer in today's market, go ahead and text the word data plus the number down below for a comprehensive data plus the zip code that you're looking in. Wow, I've had a lot of coffee this morning. Go ahead and text the word data plus the zip code that you're looking in, and we will get you a comprehensive data set for the neighborhood or area that you're looking in. And if you're a home seller in today's market, go ahead and text the word data plus the property address, your property address, so that we can get you a very robust data set for your particular property. This is Danny Gould, everyone, with the Selling Silicon Valley Group, and I'll catch all of you in the next video.